In the second part of Chapter 16, we will be talking about a second type of computation on earnings per share, which is called diluted earnings per share. Now think of that word dilution, as I said in our prior lecture. Dilution is adding, and making it less than what it is now. You can think of it as like your Kool-Aid or your iced tea. When you make it according to the package, it's fine. But when you add more water, you dilute it. With earnings per share, we're adding more common stock that could be and is out there and can become common stock. So there's certain items that we pay attention to and use in this computation. They are options. So remember, a share option and warrant is a piece of paper basically that gives the holder the ability to buy common stock. So if the company has any of these items outstanding, they are considered in this second computation. Basically, we're saying if someone does exercise those options and warrants, what would be earnings per share with more common stock outstanding? Same if the company has convertible preferred stock that can be changed into common stock. Those common shares, if that stock is converted, would also add to our denominator in our computation of earnings per share. Adding more common shares will then decrease earnings per share or dilute it. Same with convertible bonds. So differing classes of common stock and what we call contingent share. These are all items that are referred to as, quote, potential common shares. Why? Because the company has those out there, people hold them, and they have the ability to convert those things to common stock. So if they were converted to common stock, what would be the impact of earnings per share? Keeping in mind what earnings per share is, net income minus preferred dividends. So only so much income is available for outstanding stock. So if we increase the denominator, we decrease our computation of earnings per share. So a corporation with these kind of items is said to have a complex capital structure. And when they have this, they have to report their earnings per share as it currently stands. We call that basic, the common shares that are outstanding. And also what would be earnings per share if everybody converted their stock warrants, their convertible preferred stock, any of those items that have the potential to be common stock. What would be earnings per share? So we want to give what it is now and then worst case scenario. So diluted earnings per share, again, is the earnings per share after including all potential common shares that would reduce overall earnings per share. How much earnings is attached to one share of stock? So potential common shares are only included in the calculation of diluted earnings per share if they have the effect of decreasing or diluting earnings per share. If the effect is opposite, we don't show it and we don't include it. So take a look. Here are the steps. First, compute your basic earnings per share. Take your net income minus the preferred dividends, if there's any preferred stock, and divide it by the weighted average number of shares currently outstanding. The second step, now include all your dilutive share options and warrants and compute a tentative diluted earnings per share. So what this is saying is, now pretend everyone who has an option or a warrant exercises it and takes more common stock. Now what would be your earnings per share? Develop a ranking of the impact of any convertible preferred stock, convertible bonds, from the most dilutive, so it would have the largest effect, a dilutive effect, largest decrease to earnings per share, to the least. So you rank them. Beginning with the most dilutive security first, include each dilutive convertible security in diluted earnings per share in a sequential order based on what you just did in step 3. And then compute a new dilutive earnings per share. So we're going to be looking at all this. And then step 5, report as the diluted earnings per share the lowest amount you computed. Now, not all companies are going to have all these different things that could cause earnings per share to be less. They might have one, they might have two, they might have all. But what we're talking about here is if they have any, you've got to compute dilutive earnings per share. Here's a great flow chart. So on the left-hand side is our simple capital structure. All we do is calculate earnings per share. But if you have a complex capital structure, what we're talking about, these types of items, you must compute dilutive earnings per share as well. And this is how we go about doing it. First, look at the effect of your share options and warrants. Then if you have any convertible securities, you rank them and then determine their impact on diluted earnings per share. Now, a corporation starts with share options and warrants, and it always starts here if these items have a dilutive effect, meaning if they were exercised, they would decrease earnings per share. Dilution will occur when the average market price is greater than the option price, the amount that the holder pays for it. We use what's called the treasury stock method when determining the effect on earnings per share. And here's what it says. The first thing we assume is that the company receives the money from the holder of the option, and the holder gets common stock. So they're issuing more common stock, and there's more common stock outstanding. But the next thing we assume immediately is that the company takes the proceeds from the person exercising the option or warrant and immediately reacquires stock out of the stock market, its own stock, treasury shares, as many shares as possible. So let's see how that looks. One more time. When we pretend that any stock warrants or stock options are exercised, the company will get money, we issue new shares. We immediately assume we take that money and reacquire our own common stock out of the market at its average market price, essentially decreasing the number of shares outstanding. The difference between the new shares going out because of the quote pretending of exercising of the options and warrants minus the amount we pretend to buy back is how much your outstanding shares actually change in your denominator. So let's take a look. Determine the average market price of common shares during the period. Compute the shares that would be issued. So we pretend that these would be issued if everyone exercised all their stock options and warrants. Compute the proceeds from the assumed exercise by multiplying the exercise price by the number of shares. Then compute the assumed shares that would be reacquired if we immediately took that cash and bought the shares back out of the stock market at their average market price. the difference between what we issued when the options or warrants are exercised and what we buy back as treasury stock is how much we increase our denominator. So it's very specific steps. Plummer Corporation has a compensatory share options for employees to purchase 1,000 common shares at an exercise price of $18,000 per share throughout the year. So that's what's outstanding at the end of the year. The average market price for the common stock during the year is $25. So if these were exercised, we wouldn't be having this discussion. But these are current stock options that are on our balance sheet. When we have those, you need to determine their impact on earnings per share if they were actually exercised. First step, the unrecognized compensation cost, net of tax, related to the share option, we need to know this, is $2 per share. So we assume the shares assumed reacquired, I should say. First of all, shares issued from the assume exercise would be 1,000 shares. What are the proceeds? How much money would we be receiving if those shares were exercised? Well, 1,000 shares times, and it's the $18 that the cash we actually received plus that unrecognized compensation cost per share of $2. That's what we would include. So the total amount of, quote, cash we would receive or value we would receive because of these options being exercised and converted to 1,000 shares would be $20,000. The assumption is we took that $20,000 and immediately went into the market and bought back our stock at the average market price of $25 a share. So we would be holding treasury stock of 800 shares. So what's the actual impact on diluted earnings per share? How much would our outstanding stock in our denominator increase by? Pretending that the stock options and warrants are exercised, $200. The difference between what we issued and what we pretend we would have bought back. Not $200, 200 shares. 200 shares. Convertible securities, remember you would be doing rankings on those. What are we talking about? Convertible bonds that can be changed into common stock and preferred stock that can be changed into common stock. When we're doing the calculation for determining the effect and inclusion in dilutive earnings per share, we use the method if converted. Each convertible stock or bond, so whether it's a bond that could be converted to common stock or preferred stock, is assumed, so we're pretending, to have been converted into common stock at the beginning of the earliest period reported. So it would be assumed they would have converted it as of the beginning of the year. Why is this important? Well, both of these items have an impact on the numerator and the denominator. Think about this. A convertible bond. What does a bond have that's required of the corporation? A bond must pay interest. If we pretend under the if converted method, for purposes of doing this calculation, that the bond was converted to common stock as of the beginning of the year, there wouldn't have been any interest expense deducted in our net income. So we will actually be adding back interest expense during this calculation because it wouldn't have been there. Of course, we would also increase our number of shares. The same impact if you convert preferred stock. Why? Preferred stock always has a dividend that we decrease in the numerator. If we pretend we converted that preferred stock as of the beginning of the year, we would have never had to pay that preferred stock dividend. So we wouldn't include it in our numerator or subtract it. And the number of shares of common stock would increase because those shares were converted. So let's see how this all jives out. Here's an example. Security A, 9% convertible preferred stock. Dividends of $5,400 were declared during the year. The preferred shares are convertible into 3,000 shares of common stock. The next security this company has, 10% bonds. Interest expense of $4,800 was recorded during the year. So it was deducted to get to our net income. There's how many shares of stock the bonds are converted into. 8% convertible preferred stock. Again, dividends of $8,000 were declared during the year. These shares are converted into 5,000. And then 7% convertible bonds. Interest expense is $6,300, and these bonds are converted into 3,150 shares. So this company has quite a few convertible securities. Now, what we do is rank them by their impact on diluted earnings per share. What we will do is take the amount of interest expense in the, I'm sorry, that is the dividend that would impact the earnings per share because we wouldn't have paid it. There would have been $5,400 more, and divide it by the number of shares we would be adding. Remember, we're pretending we did this as of the beginning of the year. So the tentative impact $1.80. So the least amount will have the most dilutive effect. We do the same thing for Part B. That's the interest expense. Security B, we would be saving $4,800 of interest expense, but issuing 1,920 new shares. The earnings per share on that is $2.50 each. So that would increase earnings per share. Security C, 8,000 of, I believe that's dividends, would be saved by converting the preferred stock. So there would be 8,000 more in net income, 5,000 new shares. The lowest impact, $1.60. So the most dilutive because it has the lowest increase to earnings per share. And then the final would be the $6,300 of interest expense we would be saving divided by the number of new shares, which is $2. So we rank these. The lowest amount or lowest impact dollar amount wise on earnings per share means it would only increase earnings per share by $1.60. Just that item. Lowest, then second lowest, third, and fourth. So we rank them. Now, a corporation computes its diluted earnings per share in the following sequence. Number 1, compute the basic earnings per share. 2, compute that first exercise we went through where we computed the additional incremental shares from exercising shares and options and warrants and then immediately purchasing stock back as treasury stock. The difference is the incremental shares. 3, include dilutive convertible securities in sequential order according to their dilutive effects on earnings per share, that ranking we just did. Repeat with each dilutive security in the ranking until the impact of the next convertible security actually causes earnings per share to increase. Any remaining securities in the ranking are considered anti-dilutive. We do not include them. Finally, dilutive earnings per share is the last tentative figure. It contains all the diluted convertible securities. So there is a flow chart. Let's do this. Okay, before we get into actually doing an example, there are some special issues that we need to talk about that are related to dilutive earnings. If a corporation reports a loss from continuing operations, that it does not include potential common shares in calculating diluted earnings per share. If it's a positive net income due to having a gain from this extraordinary nature, really that would already be included in your continuing operation, or a discontinued operation does not change this requirement. Davis Corporation reports a loss from continuing operations and income from discontinued operations. Davis has 50,000 weighted average common shares outstanding. They also have a convertible bond that can be converted into 12,000 shares. When calculating earnings per share, we would first calculate basic earnings per share. 75,000 divided by the 20,000, no, that's not right, by the number of shares outstanding. I can't go backwards either on here, and I apologize. Income from discontinued operations would be the 97,000 divided by the number of shares outstanding. Net income, same thing. 22,000 divided by the number of shares outstanding. Since there is a loss from continuing operations, that's also your diluted earnings per share. So that's your first special situation. If it's income, though, from continuing operations, you move forward with the calculations we'll be showing you in a few seconds. Ryan Corporation reports income from continuing operation of 30,000 and a loss from discontinued of 63,000. They have 40,000 weighted average shares outstanding and a convertible bond that can be converted into 15,000 shares. So they don't have any stock warrants or anything like that. Let's see what happens. Income from continuing operations is 30,000. Loss from discontinued operations 63. Overall net loss 33,000. When reporting their loss from continuing operation, well, that should be income from continuing operation, right? They would take their income divided by the 40,000 shares. The next would be the loss from discontinued operations, $1.58, the loss divided by the 40,000 shares. And then net income, which would be your loss, divided by the 40,000 shares. You would then take your income from continuing operations for diluted earnings per share, the 30,000, and divide it by the number of shares that would be outstanding if you converted the stock, converted that convertible item into the stock. So there's 40,000 now. You would have had an additional 15. So 30,000 divided by 55,000 shares, 55 cents. Same with the loss from discontinued operations. $63,000 loss divided by your new shares if converted. So the difference between the two is on the first one, we had a loss from continuing operations. That's it. We shut down. No diluted earnings per share. Earnings per share basic, diluted, same in all three categories. But when you have income from continuing operations, you move forward with calculating diluted earnings per share for all three categories. So let's take a look at the computation of earnings per share for Randolph Corporation, assuming the following, and this should be in your book too. Their share options outstanding. Both convertible bonds and convertible preferred stock are outstanding. So this company has a lot of stuff that will be used in calculating diluted earnings per share. The convertible bonds are dilutive, but the convertible preferred stock has already been determined to be anti-dilutive, meaning if we included that, it would cause earnings per share to go up, not down. And the whole purpose of calculating dilutive earnings per share is to determine what's the worst case scenario for earnings per share. What's the lowest it can go if everybody starts converting all these things? The computation results in dilutive earnings per share of $1.94. Note, Randolph reports both basic and diluted earnings per share on its income statement. So it's not a one or the other. You report both. If you just have basic, though, you just report basic. So here we go. Here's Randolph. Income statement information. Net income is $2,800. Income tax rate is 30%. 900 shares of common stock were outstanding the entire year. The options were outstanding the entire year. The assumed exercise of these options would result in an increment of 85 shares. So they've already done the computation where we determine how much money the corporation would get if all these shares, these options were exercised, and already did the calculation of how many shares would be bought back under the Treasury method. So the net effect on our outstanding stock would be 85 shares. The company has 100 shares of 8%, $100 par convertible preferred stock outstanding the entire year. They had 800 dividends were declared on this stock. Each share of preferred stock is convertible into 4 shares of common. So 100 shares, and there was an $800 dividend. I have to jot this down. The next item, they also have convertible bonds. The convertible bonds have a $5,000 face, outstanding the entire year. They have a 6% interest rate and were issued at a discount. Bond interest expense is $320 for the year. Total discount being amortized at the rate of $20 per year. Each $1,000 bond is convertible into 32 shares of stock. So they have 5 bonds that are $1,000 each, 32 bonds each, or 32 shares of stock each. Okay. The impact on diluted earnings per share and resulting ranking. Now, we want to see what C and D, what kind of impact. First of all, if the convertible preferred stock was converted, we would not have had to pay $800 in dividends. So there would have been $800 more in earnings in our numerator. But there also would have been 400 new shares of common stock in our denominator, causing earnings per share just from that item to be $2 each. The bonds, $5,000 face value. Okay. Oh, okay. Let me just do something really quick here because I think they made this much harder than it needed to be. Yeah, they did. Okay. The bonds. The company included in their financial statements $320 of interest expense. What is that from? It's from the interest payment they had to make, the $5,000 face times 6% or $300, plus the $20 of amortized discount. If they had converted those bonds as of the beginning of the year, the company would have never had that $320 of interest expense. So what is its impact on our diluted earnings per share? The numerator would have been net of tax $224 higher. 320 times 70%. If the interest rate is 30%, we would have 70% remaining. How many shares of common stock would have been included in our denominator, 160. So its impact on earnings per share just from that item is $1.40. So the bonds are the highest amount of dilution. The preferred stock is ranked second. Now remember, we got those 5 steps. So let's see what happens next. When we compute our basic earnings per share, our numerator is our net income, which was $2,800, minus actual preferred dividends of $800, because we do have preferred stock that we paid preferred dividends on. That's where the earnings in the $2,000 come from. We then would divide it by our weighted average number of shares actually outstanding, which they gave to us, 900. So our normal basic, this is it, $2.22. The next thing, though, is we have to see what is our diluted earnings per share since we have a complex capital structure. We have items that can be converted into common stock. Well, the first item we take into account are stock warrants and options. In Part A, I think it was, they told us the impact, the number of new shares would be 85. Stock warrants and options have no impact on our numerator. They have nothing to do with net income or preferred dividends. We would just add the number of new incremental shares for the year of 85. So including those and pretending that they actually were converted into common stock would cause our earnings per share to decrease to $2.03. Now, the next thing we do is determine the impact of our most dilutive item of the convertible bonds or preferred stock. We start with ranking 1. The savings and interest, remember, would be added in our numerator for the convertible bonds, 224. Okay, 224. How many new shares of stock would also have been added to common stock if the bonds were converted as of January 1? Well, we wouldn't have had $224 of interest expense, so our numerator would have been 2224 higher, and we would have had 160 more shares. So now, if everything was converted, the stock warrants and options and the convertible bonds, our common stock outstanding for the year would have been $11.45. So what would have earnings per share been if those items were converted? $1.94. You see the dilution. Right now it's at $2.22. What we're telling decision makers is, well, we got some stuff out there that can be converted into common stock. And if it was, those two items would have caused your earnings per share to be lower, $1.94. Stockholders don't like that. So we've got to show them. Now, if you take a look at little e, the convertible preferred stocks overall earnings per share effect is $2. It says the $2 impact on diluted earnings per share is more than the $1.94 it currently stands at. So if we had included it, it would actually cause our earnings per share to go up. So let's do that calculation so you can see it. What would happen? Well, currently our numerator is at 2224, right? That's the net income plus the interest expense that we wouldn't have had if the bonds were converted, okay? Minus preferred dividends, because we actually have preferred stock that paid preferred dividends. Well, if we had converted that preferred stock as of the beginning of the year, our numerator would have been $800 higher. We would have never subtracted that. So our new numerator would be $3,024. Now, how many new shares were there? Currently, there's 1,145, the original 900, then the 85, pretending that the stock options and warrants were converted. What would be the impact? Then showing the impact if the convertible bonds, 160. Now, what would be the impact of these convertible preferred stock? Well, we would have had 400 more, or 1,545. So now calculate earnings per share after adding the preferred dividends back, because we wouldn't have had those, and adding the new common stock in the denominator. I'm using my phone, so just bear with me. So 3,024 divided by 1,545. Earnings per share would be at $1.96. Your new diluted earnings per share. You can't report that then. So remember, diluted earnings per share is the amount we calculate that is at the lowest amount. So you can calculate it and say, oh, it would be $1.96. But of the $2.03, the $1.94, the $1.96, which is the lowest? The $1.94. So that is what would be reported as diluted earnings per share. And that is how you go about calculating and reporting diluted earnings per share. That's a great example. There's some additional considerations. After issuing convertible securities or share options, a corporation, you know this could happen, may declare a stock dividend or stock split. Typically, the conversion ratio for convertible securities and stock options is proportionally adjusted for these stock dividends or splits. So in other words, what it's saying is, if you are assuming in your diluted earnings per share calculation that the items were converted as of the beginning of the year, any stock dividends or splits would have affected it. So you would need to double or triple those shares. Contingent issues, a corporation may be obligated to issue common shares in the future. The stock is referred to as contingently issuable common stock. Okay, so you need to keep those in mind. Here are some earnings per share disclosures from Starbucks. You could see they report diluted earnings per share, and it's always either equal to or less than normal earnings per share. They even show you how they have their basic and diluted weighted average shares outstanding. Here's the note to the financial statement. You could read through that. And then there'll be some questions, of course. So read through the questions. Make sure you understand how to do this calculation. If you have any questions, please post them to the discussion board. That concludes our discussion of diluted earnings per share.